There's a $3 trillion market. Banks use it, sovereign wealth funds use it. Family offices across Switzerland, Singapore, Dubai, London, they use it every single day. And yet, if I ask 10 successful professionals what a structured note is, 9 of them will not be able to give me a clear answer because nobody has taken the time to explain it properly. And this is what I'm trying to change with this series. This is the first episode of the Structured Note series with 40 videos. Just the information that was previously reserved for high net worth individuals with a minimum of $1 million to invest. Every week, I sit across from senior executives, business owners, C-suite professionals. All of them are very accomplished people. And many of them have been offered structured notes by their banks. The presentations are polished, the term sheets looks professional, the banker explains the headline like 8% coupon, capital protection, 3-year term, but what they never explain is how it works at a deeper level, how the product is built, where the risk really sits, what the bank is earning from the deal. And this is one of the biggest gaps in wealth management today. It is not that people are making bad investments. It is that they are making investments they do not understand, and there is a massive difference between the two. Let me give you a real scenario. Last month, I met a business owner. He had a significant amount sitting in a savings account, but earning 3%, barely keeping pace with inflation. He wanted income, real predictable income, but he was not willing to take risk in the stock market because of the volatility. Using structured notes, we built him a portfolio paying over 10% annual income with a 40% protection barrier. What does that mean in plain English? As long as the market does not crash by more than 40%, he gets paid quarter after quarter. He sleeps well, his cash flow is predictable, and if there's a moderate correction, he is still protected. Now, here is the thing. His bank has been offering him structured note for years. He never invested in them. There was nothing wrong with the products. He just never understood them well enough to say yes. That gap between a powerful product and a confused investor is exactly why this series exists. Now, if you are a senior professional, earning well, building your assets carefully, and you want to know exactly what your money is doing, this series is built for you. In this series, I'll be covering all the details about structured notes, its features, the risk associated with it, the benefits, and how to evaluate a structured note with real case studies. So, by the end, you'll be able to take an informed decisions whether structured notes are for you or not. So let me start with the basics. What exactly is a structured note? A structured note is a financial product. It is issued by major banks like JP Morgan, Goldman Sachs, UBS, Citibank. It falls under the category of a bond. What I mean to say is, it is a loan which you provide to the bank, and in return, the bank gives you a promise. A normal bond says, I will pay you 4% every year no matter what. A structured note says, I will pay you 10%, for example, every year as long as certain market conditions are met. The 10% is called a coupon, or the returns in structured notes are called coupons. And the conditions, that is where the customization comes in, is where it gets interesting. A structured note is something like a plain sheet of paper. You tell me what you want. I want 100% capital protection. Done. The banks will create it. Or I am ready to risk 20% of my capital. Done. I want my investment linked to Nvidia or S&P 500. I want payouts every quarterly or monthly or yearly. I want this for 3 years or 5 years or 12 months. I want it denominated in dollars or GBP. The banks will create it for you. Everything is customizable, every single detail. Traditional investment is like ordering of a fixed menu. You look at what is available, you pick the best option, but you are limited to what is on the menu. Meanwhile, structured notes are like walking into the kitchen and telling the chef exactly what you want. The ingredients, the flavor, the portion size. Now, most people do not know this option exists. Now, you might be thinking, if it is so powerful, Why have I never heard about it? Why is there almost no content about this on YouTube? Very fair question, and the answer is simple. In private banking, structured notes are the core of wealth management. This solution is not new. Ultra high net worth individuals have been using this for decades, but the minimum used to be $1 million US, and at that price point, the banks are not going to make YouTube videos. They are going to have a quiet conversation in a private office in Geneva or Singapore. The people who understand structure notes well enough to teach them are too busy selling them. They work for the banks. Their job is to generate commissions, not to educate for free. That is why I say structure notes are not complex, they are simply unfamiliar. The product itself is quite logical. The confusion comes from how it has been explained, or more accurately, how it has not been explained. That is all. Now, because of technology, because of regulatory changes, the minimum has come down significantly. What used to require $1 million, you can now access with a fraction of that. The product is the same. The only thing that has changed is the entry level, and that is exactly why this series exists. To give you the education that used to come with a 7-figure account balance. Let me make this even more concrete. Here's a real structure note I recently reviewed, issued by UBS. It pays 8% per year. It is linked to the S&P 500, and it has a 60% barrier with a tenure of 3 years. What does that mean? If the S&P 500 stays flat over the term, you get your 8% annually. If the S&P 500 goes up 50%, you still get your 8% every year. You do not get the extra upside. If the S&P 500 falls 20%, you still get your 8%. You are protected. But, and this is the important part, if it falls more than 40%, you start losing money. How much you lose? That depends on how the note is structured. So the question becomes, is an 8% annual coupon worth giving up unlimited upside in exchange for 40% of downside protection? For some people, absolutely yes. For others, no. This is not right or wrong. It depends on what you need, what your situation is, what keeps you up at night, and that is the beauty of it. Because if 8% is not enough, you can ask for 10. The barrier level might increase to 70%. If you want more protection, say 50%, the coupon might come down to 6. Everything is negotiable. You tell me what you want and the banks will create it for you. Over the next 39 videos, I will show you everything. How banks actually design these products, how the risk really work, when structured notes are brilliant and when they are not a good fit for you. I will show you real client wins and the real client losses, how banks profit and how you can benefit. By the end of this series, you'll be able to pick up any structure note term sheet and evaluate it in 5 minutes. You will know what to ask, what to look for, and what to walk away from. This is a skill set most private bankers do not want you to have. I recommend watching this series in order. Each episode builds on the previous one. In the next video, I am going to show you exactly how banks create structure notes, how they price them, and where their profit sits inside the product. Once you understand that, you'll never look at a term sheet the same way again, and everything else in the series will click into place. If you have questions, feel free to reach out. If you found this useful, I'll see you in the next one. And by the way, the actual term sheet for the note I mentioned is linked in the description. Have a look.